for those of you that are driving or you're on your plantation, aka job at work, and you can't take copious notes, know that as soon as this program, this live broadcast is complete, this radio broadcast, like all of my broadcasts, will be placed on demand on our website at www.askthewiz.info. That's www.askthewiz.info for your perusal at your leisure. Okay? Now, here we go. Now, where do I start as a trader and investor? That's the number one question that I get from first-time traders and investors. Where do I start? Now, it may seem simple, but unless you are the one actually having to think strategically about your goals, doing the research and then deploying cash into a portfolio, it's easy to forget just how paralyzing this situation can be. You see, there are many reasons this paralysis sets in. With literally thousands of mutual funds, ETFs, bonds, stocks, and other financial products to choose from, it could be simply the training of too many choices, as it were. It could also be that the memories of losses experienced during the most recent financial crisis are still too raw, still too fresh, if you will, and you don't want to get back into trading and investing. And now, especially with major market averages near all-time highs, it could be even more difficult to know what to do. Whatever the reason is that you are utilizing, simply not knowing where to start is the single biggest problem traders and investors face. It's also the one, like I said, I'm personally asked about most often. Now, beginning with the following premise, okay, that you have $5,000 or you have $10,000 or you have $20,000 or you have $500, I want you to consider the following. I have set out to address the question of what should a new trader and investors do in order to meet their goals today. Of course, every trader and investor, they have goals that are going to be different as time goes on. So I came up with 3 different models depending on your risk tolerance. And keep in mind, whether or not you have $500, $5,000, or $50,000, it's just a starting point. This can be scaled up or down depending on what you are currently working with as far as capital. Now, I would like to point out, these income strategies that I'm about to give you, they work perfectly well with dollar cost averaging. And dollar cost averaging is the strategy of buying a fixed dollar amount of stocks on a regular schedule. It's a powerful tool for edging carefully into the market or for investing spare cash. As an added bonus, by reinvesting dividends, the way we do in ASK THE WIZ Wealth Institute, many people, okay, can further increase their income and their income potential down the road. But dollar cost averaging doesn't just mean picking up more shares of the same stock as its price goes down. No, we sometimes we spin out, we'll do a put option strategy on it and get paid as we create arbitrage off margin as the underlying stock moves to the downside with our put option. But while buying more of a stock as it declines is one way that some people do, the only way we would do that is if we go with the put option, not a straight up stop buy. Okay? I still think that you need to consider dollar cost averaging as a way to instill discipline into your trading and investing. Now, the easiest way to dollar cost average is to gradually move a fixed amount of cash into the market at regular intervals. This way, unavoidable market fluctuations work in your favor. Now, the way cost averaging works is this. The basic premise is when the market is lower, you automatically buy more shares of the same stock or fund as its price moves to the downside. We put a variation on that, and we go with put options. And we get P.A.I.D as a position falls to the downside. We're not buying as a position falls down and waiting and hoping that it's going to rise back up to create arbitrage off margin. And that's what people are waiting for with the straight up stop buy. No, when we go ahead and go into our option strategy, when a position moves to the downside, we get paid instantly. Ain't no waiting. Because as the underlying stop moves to the downside, it catapults our source to put to the upside, and we get paid real time. Okay? Then, a basic premise of dollar cost averaging, okay, is that when the market moves higher, the size of your investment, both in percentage terms and in terms of the number of shares, will be lower. Now, yours truly, strongly urge those of you that are listening now to consider putting that slight variation on dollar cost averaging. Don't do it like the textbook says you do it. When you have an underlying position that's moving to the downside, yes, redeploy capital into that position, but not by buying additional shares straight up. No, you're smart. You come back on the backside, get your put options on that thing, and then hope that underlying stock falls even further, so that it catapults your put option even higher, and you get paid in real time. Then you can do an analysis, and when you think the position is bottomed out, then you can come back. And if you just have to buy position straight up, then you take your call. All right? And or buy the stock straight up. We clear on that? All right. So, without further delay, here's what I have to say to people about the starter portfolio. Now, I've come up with 3 different variations of the basic starter portfolio in terms of the positions and their relative weight to address a variety of investment goals. Please note that all of these portfolios have a similar cash allocation. That's done to stress that cash is essentially a risk-free investment, albeit one that is, in today's environment, does not generate any discernible income. But by varying the amount dedicated to cash, you can accommodate your personal risk tolerance. Now, some of you have sent me emails, okay, pointing out how you used recommended portfolios to start your grandchildren's portfolios on their investing path, or you utilized various recommended portfolios to jumpstart your trading and investing. Now, for my younger listeners out there now, okay, who've just begun trading and investing, as well as for the parents and grandparents who are listening now, who think ahead for the future, I want to start with an aggressive portfolio, okay, and this portfolio assumes high risk, a long-term horizon, 30 years until retirement, and limited income needs, okay. Once again, my aggressive portfolio assumes